Hi everyone, this is Mrs. V Chan. Welcome to my Form 6 Cost Accounting lesson number 6. So today's topic is the difference between absorption costing and marginal costing. And then we are going to use the same example in the previous video, but however we are going to use another way to present the income statements under absorption costing and marginal costing. Alright, so here we have the same example in the previous video. Alright, and then we are given the selling price per unit, and then direct material per unit, direct labor per unit, and also very important, we need to identify, the cost behavior for each item. Alright, and then after that, we have this factory overhead per unit, which is $30, and then variable factory overheads $5 per unit, and fixed selling, and then variable selling overheads. Okay, and also we have this information in January, February, and March. Okay, and then you can see in January there's no closing inventory because how many units produced here is 1,000 number of units produced, and then we sell the same number of units, so we have no closing inventory left. But however, when we come to February, so you can see the number of units produced is 1,300, but however, we only sell 800, so we have this closing inventory, 500 units. And also, this is February. The closing inventory in February will be the opening inventory in March, so that in March, we start with this 500, okay, in February, so this 500, and then we produce another 900, in the month of March, so that will be 500 plus 900. Now we have 1,400, and then how many sold here, which is 1,100, so that therefore the closing inventory in March will be 300 number of units. Okay, so therefore we have the income statement under absorption costing and marginal costing in the month of January. All right, so now here we have sales. So sales is equal to, this is the selling price times quantity sold. And then there is no difference between absorption costing and marginal costing for sales. All right, so however, after sales, we have this less cost of goods sold. All right, so how do we calculate cost of goods sold? There is another method, that is, this is same as quantity sold. But however, in order to earn money, so cost of goods sold must be valued at costs. Okay, so therefore I need to work out the step. How much will be the product costs per unit? Okay, so here I have my workings to work out the production cost per unit under absorption costing. All right, so we have direct material per unit, direct labor, variable overhead per unit, and then fixed overhead per unit. So therefore, 65 will be the total cost per unit under absorption costing. So why we include this fixed overhead as well? Because under absorption costing, all right, all costs will be important because the purpose for absorption costing is for reporting. So therefore, I have 65 here. Okay, so I put 65 here for production costs per unit. And then in January, we have sold this 1,000. All right, okay. And then what about under marginal costing? Okay, so what cost is not included here? Variable, because under marginal costing, the purpose is for decision making, so therefore fixed overhead is irrelevant to decision making. Therefore, the cost per unit, we only have this direct material, direct labor, and variable overhead, so which is 35 per unit. So therefore, I have this 35 as product cost per unit, and then times quantity sold, I can get cost of goods sold under marginal costing. Alright, so here I have my cost of goods sold under absorption costing, which is 65,000. Okay, that will be the cost per unit times quantity sold, which is 1,000 in January. And here 35,000 will be cost of goods sold under marginal costing. Alright, so here absorption costing, we have sales minus cost of goods sold, so that I get my gross profit as 35,000. But under marginal costing, we don't have gross profit. We change gross profit to contribution. But don't forget, to work out contribution, we need to minus all the variable costs as well. So therefore, I have this variable selling overhead, right? And which is equal to, okay, I need to look at the information for variable selling overhead. So here I have variable selling overhead, which is $4. So I have $4 per unit. Okay, since this is related to selling, so that must be quantity sold, so that would be 1,000. So this is the way we get contribution under marginal costing. Okay, next we get gross profit, which is 35,000 under absorption costing, and then now we have contribution 61,000 under marginal costing, which is equal to sales minus all the variable costs, including variable selling overhead. All right. So after that, finally we come to period costs in the profit and loss account. So we only have fixed costs treated as period cost under marginal costing system, and the normal situation for period costs under absorption costing, which is same as the purpose for reporting. So, okay, which is exactly same as what we have in financial accounting. So that finally we get net profit 30,000 and also net profit 30,000, both under absorption costing and marginal costing, because in January we do not have any opening inventory and closing inventory. Okay, so next, let me tell you that actually we have another way to work out this total contribution, 61,000. So here I have my workings for contribution. So we can just start with selling price per unit and then minus all the variable costs per unit, so that we have direct material, direct labor, variable overhead, and variable selling overhead for each unit. So therefore we have this contribution per unit, so that we get this 61,000. All right, so this is for 1 unit. So how do we get total contribution? Therefore total contribution, all right, so will be equal to 61 per unit times, okay, so contribution, which is the quantity sold in January, which is 1,000 number of units sold. Okay, so therefore I get this 61,000 as total contribution, which is same as contribution here. All right, so that we can have another formula saying that, okay, what is contribution per unit? Contribution per unit is equal to selling price per unit minus all the variable costs per unit. Okay, so you will find this formula very useful for the later examples, right? Okay, now we come to the situation in February. So units produced is 1,300 and units sold is 800. So therefore we have this closing inventory of 500 units left in February. All right, so here is the income statements. So under absorption costing, so we have sales, which is always the selling price times quantity sold, and there is no difference under marginal costing. All right, so and then this minus cost of goods sold. So cost of goods sold is equal to the cost per unit 65. We don't need to calculate that one more time because we already get it here in January. 65 under absorption costing, $35 per unit under marginal costing system. Okay, and then quantity sold, which is same as this 800, because if you use the usual formula for quantity sold, it would be opening inventory. So in February we don't have opening inventory, plus unit produced. So let's check what is unit produced. So here is unit produced 1,300, right? So I have this 1,300, and then minus closing inventory 500. So what is it? So if 1,300 minus 500, so that we get same, see, number of units for quantity sold. So simply you just put 65 as the cost per unit times quantity sold, which is same as this. All right. Okay, so here we have sales under AC, which is 80,000 minus cost of goods sold under absorption costing, which is 52,000. However, this is not yet gross profit, because something very important, we need to look at the factory overhead absorbed, which is 30,000 times 1,300, which is unit produced. Okay, let me show you. So here we have this FOH per unit, which is 30. So times unit produced, so that would be 1,300. All right, so that here we have 39,000, which is too much because the actual factory overhead is only 30,000, so that we have over absorption of 9,000. All right, so that here is overstated because of overhead absorption. Okay, so I need to add back. All right, this is overstated. Overhead absorption, which is 9,000. All right, now I can get my gross profits under AC. All right, however, this is sales under MC minus cost of goods sold under MC. All right, so I cannot get my contribution yet because all costs, including variable. So we have variable selling overhead, which is $4 times, okay, unit sold, which is 800 here. Okay, so now I can get my contribution under marginal costing system. All right, so therefore what is very important under absorption costing, so you have to make sure that you make adjustments related to over absorption or under absorption. All right, so this is the explanation and the steps. Okay, and then this is for the remaining period costs under absorption costing, and then we have the remaining fixed costs treated as period costs under marginal costing. And also there is another way to prove this total contribution. So since we worked out before what is the contribution per unit, so let's get back to January. So we already worked out this contribution per unit, which is equal to selling price per unit minus all the variable cost per unit. We get the $61 per unit. So here I have $61, okay, times quantity sold. Here you use your calculator, actually we can prove it as well, which is total contribution 48,800 under marginal costing system. All right, so and then what is the difference in February? The net profit under AC is bigger than net profit under marginal costing. So why so? Because we have closing inventory of 500 units in February due to the difference of fixed factory overhead here. Okay, this fixed overhead, which is included in AC as part of production cost but excluded under MC, so that 500 times 30, so this is wrong. Okay, it should be 15,000. Okay, explaining the difference between net profit under absorption costing and net profit under marginal costing system. Okay, so finally we come to March. All right, so that in February we have closing inventory of 500 units. So to begin with, this will be opening in March. So opening, we start with 500 and then we produce another 900, so that altogether 1,400 units and then minus quantity sold. Therefore, we also have closing inventory of 300 units. So not only opening inventory we have in March, but also there is closing inventory in March. All right, so here is the income statement under absorption costing system and marginal costing system in March. All right, so we start with sales. Always selling price times quantity sold. So this is quantity sold 1,100. So I have 1,100 here and no difference under marginal costing. Okay, and 65 per unit under absorption costing, same as before, times quantity sold as well, and then here 35 times quantity sold as well. So you can realize that the quantity, the cost per unit under MC is always smaller than the cost per unit under AC, because under MC fixed overhead is not included as it is not relevant to decision making. And why this 1,100? So if we use the usual formula, we have cost of goods sold, quantity sold always equal to opening inventory plus production minus closing inventory. So if I start with 500 units in February as closing, this will be opening in March plus. All right, so what is the unit produced in March, which is 900. So I have 900 here, and then minus, okay, what is closing inventory in March, which is 300. Okay, it's the same as quantity sold, 1,100 units. Okay, so simply speaking, you just follow this, the quantity sold times costs, and sales is equal to quantity sold times selling price. Okay, so to work out gross profit under absorption costing system, so after we have sales less cost of goods sold, don't forget to adjust whether we have over absorption or under absorption. So here we have analysis in March. So we have this factory overhead absorbed, which is $30. So because we have $30 here, and then times 900 unit produced, so that we get this factory overhead absorbed, which is 27,000. However, if you compare this with actual one, which is 30,000, therefore we get this under absorption. Okay, so here is the adjustments. We need to minus under absorption to get this gross profit 35,500. All right, and then here, so this is under marginal costing, so don't forget all variable costs to be treated as this. Okay, so that's we get this contribution. So this is total contribution. Remember, we can always get contribution in another way. That is, this is $61 per unit as the contribution per unit, which is equal to selling price per unit minus all the variable cost per unit. So that we have this 61 again, 61 times the quantity sold to get total contribution in another way. So here we have what's left in the income statement under absorption costing. As usual, we have these expenses treated as period costs, and then under marginal costing, we only have fixed costs treated as period cost, and therefore we get net profits under absorption costing, and then this is net profit under marginal costing. But this time, marginal costing is bigger than absorption costing, and then I'm going to do the reconciliation statement with you. So to explain the difference in net profits, and then I'll start with net profit under AC, which is 30,100. So why we have difference of net profits in March? Because we have opening inventory. There is opening inventory. So opening inventory under AC is always bigger than opening inventory under MC. Remember, because costs of production under AC is 65 per unit. This is always 35 because what is not absorbed, fixed factory overhead is not absorbed. So if we have opening inventory bigger than that, then cost of goods sold will be bigger under AC. So bigger cost of goods sold, net profit will be smaller. So therefore I need to add. So this is fixed overhead absorbed in opening inventory. Okay, and how much is that? So $30 for fixed overhead per unit times, so what is opening unit? So which is 500 number of units. So I have this 15,000, right? Okay, so in March, not only opening inventory, we also have closing inventory. So again, I have another diagram. So now we have closing inventory under AC always bigger than, okay, always bigger than closing inventory under MC. All right, so closing inventory bigger, then what happened to cost of goods sold? And then cost of goods sold MC. So formula of cost of goods sold is equal to opening inventory plus production minus closing inventory. If you minus closing inventory, which is bigger, then cost will be smaller. All right, so smaller costs, then net profit under AC will be bigger than net profit under MC. All right, so net profit this time will be bigger, so I start with a bigger one. Okay, and to work out the net profit under MC, so I need to minus fixed overhead absorbed in, this time it is closing inventory. Again, the fixed is 30 times. So what is the closing number of units left? Okay, let me find number of unit left. So here is the closing units, 300 left. So times 300. Alright, so where's my calculator? So here is my calculator. So therefore I have 30 times 300 minus 9,000. Okay, so I'll start with this 30,100 plus 15,000 minus 9,000. Oh, see? How much is net profit? Which is same as net profit under MC. So this is the reconciliation to show and explain the difference of net profit under AC and MC. Right, okay. So that's all about today's lesson. So thank you for watching. I'll see you next time. Bye bye.